Every nation borrows. At first, borrowing feels powerful. It accelerates growth. It funds infrastructure. It expands military reach. It supports welfare systems. Debt, in early stages, feels like leverage. But leverage has a cost. And history shows that when debt outpaces productive capacity, systems begin to strain. Let us begin with a simple truth. No modern nation operates without debt. Governments issue bonds. Central banks manage liquidity. Financial institutions purchase sovereign securities. The system depends on confidence. When confidence is high, borrowing is cheap. Expansion continues. Asset prices rise. But debt does not disappear. It accumulates. And when accumulation exceeds growth, fragility increases. This is the debt trap. Not a conspiracy. Not an accident. A structural outcome of incentives. Consider the Roman Empire. Military expansion required constant funding. When conquest slowed, revenue slowed. Spending did not. Currency was debased. Trust weakened. Inflation emerged. The system strained from within. Move forward centuries. The Spanish Empire extracted vast silver from the Americas. But instead of building diversified productivity, it relied heavily on external wealth inflows. Debt mounted. Inflation rose. Multiple sovereign defaults followed. Then the Dutch Republic. Then France before the Revolution. Then the British Empire during its late stage. Different eras. Same pattern. Debt expands during confidence. Confidence erodes during stagnation. Now observe modern economies. Debt today exists at levels unprecedented in peacetime. Government debt, corporate debt, household debt, all interconnected. When interest rates are low, servicing debt appears manageable. But low rates create incentive for more borrowing. Cheap capital fuels asset inflation. Real estate expands. Stock markets surge. Corporate buybacks increase. Growth appears strong. But examine productivity. If debt grows faster than productive output, the system becomes dependent on continued expansion. That is the trap, because expansion cannot continue indefinitely. When growth slows, governments face difficult choices. Raise taxes? Cut spending? Inflate away debt? Refinance indefinitely? Modern systems often choose refinancing. Roll old debt into new debt. Extend maturity. Lower rates. Increase liquidity. Central banks become pivotal. In crisis, they inject liquidity. They purchase bonds. They stabilize markets. This prevents collapse, but it also normalizes intervention. Over time, markets assume rescue. Risk increases. Leverage increases. Asset concentration increases. The wealth effect strengthens. Those who own assets benefit. Those who rely solely on wages feel pressure. Inequality expands quietly. Public frustration rises. Political polarization intensifies. Debt is no longer purely economic. It becomes social. Now consider the global layer. Many nations borrow in their own currency. Some borrow in foreign currency. Those borrowing in foreign currency are more vulnerable. If their currency weakens, servicing debt becomes harder. Capital flows out. Confidence declines. A crisis emerges. This pattern has repeated across emerging markets for decades. Currency vulnerability amplifies debt fragility. Meanwhile, reserve currency nations enjoy structural advantage. Global demand for their bonds sustains borrowing capacity. But even reserve status does not eliminate limits. If debt servicing consumes increasing portions of tax revenue, policy flexibility shrinks. When interest payments rival defense budgets, choices narrow. History shows that empires decline when flexibility disappears. Not immediately, gradually. Empires decline when flexibility disappears. Not immediately, gradually. Infrastructure ages. Innovation slows. Confidence erodes. Debt, in itself, is not evil. It can finance growth, but when growth slows and debt persists, dependency emerges. Dependency reduces sovereignty. Now we approach the uncomfortable question. Can modern nations exit the debt trap? There are historically three paths. Growth outpaces debt, inflation erodes real value, or restructuring occurs. Growth is ideal, but requires productivity innovation. Inflation reduces real debt burden, but damages savings and trust. Restructuring resets balance, but damages credibility. Most modern systems attempt gradual inflation combined with growth. Moderate inflation, controlled liquidity, managed expectations. It is a delicate balance. Too little liquidity, recession deepens. Too much liquidity, currency weakens. Debt traps are not explosive events. They are prolonged constraints. Policy becomes reactive, not proactive, and reactive systems are fragile. Now examine demographics. Aging populations increase pension obligations. Healthcare spending rises. Workforce growth slows. Tax revenue growth weakens. Debt pressures intensify. Demographics amplify structural debt issues. Add geopolitical tension. Defense spending rises. Supply chains fragment. Efficiency declines. Costs increase. Debt expands. The trap tightens. But here is the deeper insight. The debt trap is not just about numbers. It is about expectations. If markets believe governments will manage stability, confidence holds. If belief weakens, rates rise. Servicing costs increase. Confidence falls further. Expectations create feedback loops. The invisible network we discussed in episode 1 intersects here. Financial institutions hold sovereign bonds. Governments depend on bond markets. Central banks stabilize both. Interdependency reduces collapse probability, but increases systemic complexity. Complex systems are resilient until they are not. Fragility accumulates quietly, then a tipping point emerges. Historically, tipping points often follow external shocks. War, financial crisis, commodity shock. The shock reveals underlying strain. The response determines trajectory. Reform, or deeper leverage. Modern systems tend to choose deeper leverage because short-term stability is politically attractive. Long-term sustainability is abstract. Debt traps rarely explode dramatically. They suffocate gradually. Confidence thins. Opportunity narrows. Mobility declines. And then power restructures. Financial centers shift. Currency regimes evolve. Policy frameworks transform. Individuals often feel change before statistics reflect it. Rising living costs. Asset price volatility. Policy unpredictability. Understanding the debt trap changes strategy. It encourages diversification, liquidity awareness, macro literacy. It discourages blind optimism and blind pessimism. Debt traps do not guarantee collapse, but they guarantee constraint. Constraint shapes policy. Policy shapes markets. Markets shape opportunity. The nations that escape debt traps historically are those that restore productivity, innovation, efficiency, structural reform. Without productivity, debt compounds vulnerability. With productivity, debt can become manageable. The future is not predetermined, but the incentives are visible, and incentives drive outcomes. Modern nations stand at a crossroads. Continue leveraging stability, or prioritize structural reform. The path chosen will define the next century. Debt always feels manageable, until it isn't. And history rarely forgives excess leverage. The question is not whether debt exists. The question is whether productivity can outpace it. That answer will determine which nations rise, which stagnate, and which restructure. And the cycle will begin again.